Well, we'll start in the only place that we really can, I guess. In the week where the Catholic Church elected their new leader, we're focusing on the only leadership transmission that really matters here, which is Warren Buffett stepping aside and handing over to Greg Abel at the end of the year at Berkshire Hathaway. Stock was down 6% after that announcement, and people were sort of torn between two thoughts. One of it being kind of making sense on that announcement, and the other being the man is 94. You cannot be surprised that he was going sooner or later. Maybe surprised that he retired rather than eventually sort of passed away at that age. But it's pretty well telegraphed what was going to happen, that it was going to go from Buffett to Abel. And I think this sort of smooths the transition a little bit. So the meeting in general was quite a bit of the usual not much these days. I had a good listen. There were a couple of things that sort of interested me. But one was the kind of story that they mentioned of Buffett said when he was taking over Mid-American, the organization that Abel was in charge of, looked at the balance sheet very carefully and saw a load of derivatives on it, which Berkshire tends to stay well away from. And he said, "What's all this?" And Abel said, "Well, these are matched against risks that we have, so they're there to try and help us hedge things." And about 6 months later, those derivatives shot up in value because of price fluctuations in, I think it was oil. And Buffett said, "Oh, cool. How much did we make on that?" And Abel said, "Nothing, because they were hedged against risks that we have. So they've gone up, but we've lost on the other side." And that was quite pleasing for Buffett, I think, to find out partly that Abel was being honest about the fact that he was hedging things, and partly that that was genuinely what they were doing rather than punting on derivatives. Anyway, I guess the question for Berkshire shareholders like me is, well, what changes with Greg Abel involved? And the answer is probably not much, and certainly not much in the short term with Buffett around being an advisor. I don't think Greg is going to be like, right, finally, okay, dividend time. I really hope he doesn't, to be honest, because I think that'd be sort of disappointing. But by reputation, he's known to be more kind of hands-on with the subsidiaries than Buffett is, takes a closer interest in what's going on with them. And is very interested in things like their capex and getting across exactly where all the money is going and what it's being used on and so on. Buffett's been more of a kind of, well, it is what it is. We'll run the business. You run the businesses. We'll own them, and you just send the money up when it kind of arrives and so on. That's the big difference that I see going forward, that there's likely to be a drive to try and get more from existing businesses within Berkshire. And I think I see that as something that could be good or could be less so, to be honest. Genuinely agnostic about what I think about it. I have feelings both ways here. On the one hand, better operational performance is probably a good thing. You never don't want that from your organisation. Closer to if Abel really can get some extra juice out of these, that would be no bad thing. I think it's a disadvantage when it comes to acquisitions. I mean, Berkshire's record has been good on the acquisition side largely, partly driven by the fact that it's got good prices for things because people know they're going to be left to run their own business that they want to run and have built up. And the more you have a reputation for being involved, the more that puts them into the kind of general auction area with everybody else. And to some extent, that doesn't remove but erodes or cuts into Berkshire's kind of unique advantage on the acquisitions market, which is at the moment quite tough. They've been after a certain kind of company. To that point, on the other hand, acquisitions haven't exactly been piling up recently at Berkshire. The cash has been piling up. The businesses they've been buying have not been piling up very much, and the stock picking has been fairly mediocre. I mean, they're very much inhibited by scale, right? Of finding the right size of opportunity in a privately run business. Would they take a stab at it and find it at the right price? And there's not many of them around. Genuine reason why acquisition's been hard. But if you think acquisition's been hard anyway, maybe now's the right time to try and focus somewhere else, like on your kind of existing operations here. So stuff like BNSF has been interesting because it's been quite inefficiently run, certainly compared to other railroads, but Abel has stuck up for that quite a bit. So that's my general thought on the transition stuff. We can come back to the kind of results in a moment, Steve. But one thing I should also point out as a kind of side note here, I listened to one other annual shareholder meeting thing this week, which was from a different organisation, although one that kind of styles itself on Warren Buffett. And the opening question, which was put to the person in charge, went as follows. We have lost all of our gains from the fund since inception. How do you explain this? In fairness, Inception for this fund is only 2023, so it's not like massive ages ago, and you can maybe get away with shoving that into the short-term noise thing. On the other hand, the S&P 500 is up 50% since 2023 when I looked, so you're quite a long way behind on this fund. First things first, Steve, would you like to take a guess at who that is? And second, I guess, any thoughts on Berkshire Hathaway and its transition?
I don't know who that is. Go on, tell me who that is.
Tell me who the most uninspiring investor you can think of that's styled on Buffett is. It's not Terry Smith.
Oh, the most uninspiring investor who's styled on Buffett.
Self-styled, I guess
Self.
you might say. I don't know whether he
So I
really
mean,
has a Buffett
I
style,
have
but he certainly
answers that
thinks
are
of himself like
not
Buffett.
for this podcast, uh, but
It's not. Well, I can say it's not a YouTuber, but he does have quite a lot of stuff on YouTube. It's actually Manish
right.
Pabrai. The Wagons Fund is back to flat from where it was in 2023 with its random looking investments in mostly things in Turkey, some airports in some other part of the world, Occidental Petroleum, and a car dealership in the US. Yeah. Question one was: we have lost all of our gains from the fund since inception. How do you explain this? Why have you done nothing in whatever it is closing in on 2 years now? Manish, the S&P is up 50%. It's been a bad year for that one, but yeah. Anyway, just thought I'd try you with that one. Berkshire
Well,
Hathaway,
Monish
anyone?
Pabrai has no original ideas, so you'll have to ask whoever he copied them off, because he's literally somebody who, do you know those people who steal other people's diagrams on Instagram and post them? That is how Monish Pabrai invests. Never an original idea in his life. So anyway, Berkshire, Steve, I was pretty interested in because that. I mean, we all knew this was coming, but this definitely throws up a lot of uncertainty because we can guess how Greg is going to act, but we don't know. Whereas with Buffett, you pretty much knew how Buffett was gonna react and how he was going to be in every scenario, and he was this constant. And you've got this huge event that Woodstock for capitalists that he throws. People attend en masse, and all of that's going to go away. I just can't imagine people are going to want to queue up to listen to Greg Abel for a number of reasons. Is that they don't really know who he is because he's never really had the limelight, but also he's just not got that pedigree behind him that Buffett has, where you would go to these events because Buffett might just chuck out a pearl of wisdom or an anecdote that would stick with you forever, like a lot of his sayings do. We don't know if Greg can do that, and we don't know what kind of manager he will end up being. So yeah, big amount of uncertainty, and I guess I think it's ended up being about 3.5% down on the 5 day, Steve. I might say that's potentially a little bit under where I would have expected it to be. I did enjoy a couple of things from when Buffett announced it. So he announced it, and it sort of looked like Greg wasn't 100% in on it. He's like, oh, I didn't realize we were mentioning this today. Kind of, I was like, shit. How am I gonna sort this out? But I also enjoyed the part where Buffett said, just to be clear, I have absolutely no intention of selling even a single Berkshire Hathaway stock, and he got this really long, standing applause, and it was a minute and 20 or something like that, almost to the awkward length. He tried to interject a couple of times, but people just continued clapping, and when they all sat down and calmed down, Buffett, sharp as a tack, said, well, I guess that could be interpreted in a couple of ways, which was, very, 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 very funny, very sharp, and shows he's still there. But yeah, since Charlie's passing, it's definitely been on the cards. This and Buffett is quite rapidly appearing to be at least frailer, I would say, and his voice is definitely weaker. Sometimes he's quite difficult to understand now when he talks, especially towards the end of these meetings when he's getting tired. So, look, I think this is absolutely the right move. I mean, what a legacy to take essentially a failing textiles business into a $1.1 trillion company now. I imagine he probably wanted to go, maybe a year or so ago, but I think he was probably waiting for this to cross this $1 trillion threshold just as a bit of a personal milestone. And yeah, what a time to go. Now, about Berkshire's valuation and things like that, Steve, it seems to me like it's right near the top end. But for a company of its class, when we're comparing it to something like a Costco or something like that, for that example, it's never traded at the kind of premium that a Costco has, and it probably should have deserved to. And it's only really recently that it's been, we've been talking about this as a sort of 12 to 15 sort of PE kind of company, Steve, and it's a lot more than that now. But yeah, it's in a risky kind of position to want to swap over to an unknown. This isn't a sort of position that I would want to be rushing out to buy it, Steve. I mean, if we were talking, 20 or 30% down from here, then yeah, I'd be definitely interested in sort of learning a little bit more about Greg and how he sees the future of Berkshire. But right about here, Steve, for me, I'm afraid it's on my avoid list. You're a holder though, Steve. Is it on your buy list?
It's not. The news broke over the weekend, and I thought if this moves big on Monday, and it might move big on Monday, I thought two things are going to happen. One is it's going to move big on Monday, and two is I'm going to be cross about this because I don't think it should. But it's sort of moved a bit. It's still towards the top end of where I think I would hang on to this. I've heard kind of fairly long-term Berkshire shareholders saying, and I think I can make a lot of sense from what they're saying here. Chris Bloomstrand said, look, this is getting to the point where we have to consider selling it because it's right up around the top end of their intrinsic value. Other things are not, put simply, elsewhere in the market, at least in his view anyway. And you kind of have to get your money where you think the best returns are. I'm very reluctant to go moving out of this thing because I've done it once. I did it back in the kind of pandemic-y times when they had sold a bunch of airlines at the lows, and I wasn't that impressed by the reason Buffett gave for doing so, and hadn't used any of their cash, and I wasn't that impressed by the reason Buffett gave for not doing so. I came to regret it pretty swiftly. I can't remember whether I got back in at a higher level or a lower level, but for the time being, I'm just sat still on this one. I mean, the latest results were pretty uninspiring. They were fine from what I saw of it. So revenues overall were kind of flat. Insurance was up a bit, BNSF up a bit, BHE up a bit, manufacturing sales and retail down a bit. Yeah, sure. Manufacturing services retail down a bit. The big kind of hit came in. The earnings per share were a lot lower, partly because stock portfolio was down quite a bit. That doesn't really make much difference to anything. That may well come back. But the big thing that was off was underwriting insurance. That profit levels were down quite a bit on that, which I had a look at this, and the main reason appears to be kind of California wildfires, to be honest, which are okay, sure. They are a risky run if you're an insurer. It's not anything crazy like that. But the reinsurance business, I tried to have a look. They were hit in both their reinsurance and their primary business. Geico did pretty well still. I asked Gemini, let's not be honest, I didn't work this out myself, for their combined ratio, which is basically the measure of their underwriting profit. So this is essentially how much of your premiums you take in go out again in either costs or payouts, or expenses or payouts, basically. So smaller is better in this case. It's always expressed as a percentage. So in the reinsurance business, it went from 81.5 to 98.7, so that thing just about broke even here. In primary business, it went from 89.3 to 101.3, so small loss, but if you get sort of 2% return on that, you will cover it. And Geico is not insuring California wildfires, it's insuring cars. Their combined ratio went from 81.2 to 79.8. In the same period, my favourite insurer has been Admiral. They had a combined ratio of 85, which is very, very good, 85, by the way, but nowhere near Geico. And that would kind of jumped out at me a little bit in the sense that I think of Geico as a generally quite bad underwriter. It doesn't have a good telematics unit. It's not particularly strong when it comes to underwriting. They tend to actually underwrite as much as they can to generate premium and then invest that cash, because that's how they tend to lean harder on the investing side of things, which is where their natural advantage has been. But I was quite impressed in general at Geico's margins, and I sort of get it from the insurance businesses. Sometimes you have to pay out on these things. Over time, you hope that will be okay. But insurance underwriting premiums were okay, but profits were down, and that's why earnings were a bit lower.
There was some evidence of that that kind of growth pulled forward sort of inventory movement going on as well at BNSF. Profit was up there about 6%. Suggestions that would have come from basically the tariff introduction and essentially people trying to get the house in order ahead of massive amounts of inventory arriving, trying to beat the tariffs. So that's where that came from. And the energy division, Steve, also did pretty well. Profit was up there by about 50%, and it was a broad gain across pretty much the whole of the energy division, and the home services brokerage unit losing less helped that. But yeah, it was we've used much of a muchness kind of report, Steve. It was I guess it was a business as usual kind of report for Berkshire, a little bit up here, a little bit there. Stock portfolio was down, causing the sort of headline profit amounts to fall. But yeah, nothing really too exciting in the whole report, I thought there, Steve. And yeah, the announcement was the real story, and yeah, I think the uncertainty really begins from here.
You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.